Welcome to the Road to 100 Million in Real Estate podcast, where you'll benefit from the opportunity to learn to become a skillful real estate investor. You'll get guidance from top industry producers, operators, and investors who are eager to help you learn from their proven strategies of success. Now to your host, Dorrance Constant.
Hey everyone, welcome to another episode. I'm your host, Dorrance Constant. Our guest today is Mark Kenney, a seasoned real estate investor, coach, two-time best-selling author, and founder of Think Multifamily. Mark started in an apartment investing career over 20 years ago as a side hustle while working 80 plus hours a week in the corporate world. He has purchased over 16,000 units in just the past few years in 14 different states. Again, Mark, welcome to the show.
Thanks for having me. I really appreciate you taking time to talk to me today.
For sure, Mark. I'm sure the folks want to know, how has real estate investing impacted your life?
Well, for me personally, I was CPA for a while, did IT. As you mentioned, I bought small multifamily properties when I was a senior in college. Actually, it's been about 29 years now, but that's where I started with my twin brother. And then my wife and I started buying small properties. And I was doing pretty well, if you want to say. I worked for the Big Four, and then I had an IT company that I started. But you mentioned about the number of hours. It was probably, typically 90 plus hours a week, sleep like 3 hours a night, not like once in a while. That was my lifestyle. And it caused some issues. Probably can imagine, with my wife, I'm not being there and no time for her and things like that. So she's like, man, it's not working. We need to do something different. And we both love real estate. I don't know why, it's just in me for some reason. And my wife does as well. And we're like, well, let's start doing larger multifamily properties. And that's what we started doing. And for me personally, it's impacted me from having more time. I don't have to ask anyone, for permission other than my wife, really, to do things and things like that. I did IT. It was always under the gun. I had people all over the world. So I was pretty much on the phone, probably 20 plus hours a day, sporadically. And so it's given me more flexibility to just kind of, do things, go places. Financially, there's no comparison. I didn't come into it originally to kind of be where I'm at now. I really came in to replace some of my IT business income. And if I could do that, I'm like, okay, I'm good. I can still have a pretty good life. But it has allowed us to kind of, exponentially increase our income and our net worth. And it's allowed us to give back, more than I probably ever thought we'd be able to give back to other, charities and things like that we're very passionate about, like sex traffic industry and things like orphanages, and gave me more time with my kids. And ultimately with our group, it gave me a community that I didn't have on the IT side. So I kind of originally came into it probably not really caring that much about it because I'm a transaction guy, a CPA, IT guy. My wife, thankfully, came into our business. Hey, we're going to build a community. Our group is called the Family Syndication Group. We'll go on vacation together, which I'm like, I'm not sure I even want to do that, but we do it every year. It's a blast. And so it's given us the ability to focus on other people as well, try to help them achieve, some sort of success, whether that means to them. And then it's also allowed me to kind of balance my life much better around even like physical health. I mean, I work out, 7 days a week. I never miss, those type of things allowed me to kind of get my life in order from a health standpoint too. And then the time aspect and financial are the big things.
You said something interesting, Mark, that you were working 80 plus hours a week, sleeping 3 hours on average a day, and that was your lifestyle. I came from the finance background where that was very typical for a lot of us as well, right? So I'm sure you're seeing the same tune as a lot of people who are listening on the show who are dedicated to their careers and having to meet tight deadlines and high level expectations. But you were able to invest on the side because you had an interest, a passion, it sounds like, with real estate. There are a lot of people who are still focused on their job, but want to invest in real estate without being active. What advice would you give to those folks?
So it's a good question. I mean, that's the way I started. I mean, I was doing small multifamily with my brother and then with my wife. But when we got into the larger, like 100 plus unit, apartment complexes, my first investment was passive because of the time perspective. And I used my retirement funds for it. So I couldn't really be active anyways. It's not allowed. But a couple of things. One, I would say, get as educated as you can. You don't have to be the ultimate, expert in every aspect of it, but you need to know how to look at a deal from an analysis standpoint. You don't have to be an Excel expert or things like that, but things to look for, gotchas that will, can completely kill a deal if you're not really, in tune to what, is being done.
Mm-hmm.
So get educated for one, find somebody that's been there, done that. I wouldn't invest with someone that's brand new. I just would not say you can't have great success with it. But, I can tell you I've done 119 transactions now. And I can tell you I know a little bit more now than I did when I did my first transaction.
Sure. Mm-hmm.
And I made a lot of mistakes along the way. So those mistakes can help someone that's a new investor coming into a deal for sure. And then just really understanding who the operator is. And I will say, especially with, as times got, tougher this year or last, 6 months or so, making sure that your lead or syndicator, where you want to refer general partner, is capitalized. Because I get called probably, a couple of times a week right now with people that deals are in trouble and they're asking do you want to buy the property from them, take it over for the loan amounts, getting foreclosed on, those type of things, which, is happening more than it had before.
Mm-hmm.
And if your leads don't have capital to put into it, either it's going back to the bank, which means you're going to lose all your money,
mm-hmm.
or they're going to come to you as a limited partner investor asking you for money. So, we've had put money in deals before, but we've never had investors once do like a capital call where we've actually had money brought in from investors to help cover a deficit. Do I like just putting money into deals? No, but there are a lot of reasons it happens. Even on a good deal, it can happen because you're waiting on the lender for reimbursement and things like that. And you're not talking 10, 20,000, right? You're talking some cases, hundreds of thousands of dollars. So making sure, the syndicator has made mistakes before, that they've done a number of transactions and that they're capitalized. Those are all important things. And that they know how to structure it as well. Without going into too much detail, you want to ask a question, are they creating a new LLC for the property? And a lot of reasons why people don't do that. I didn't do it once ever out of 119 deals, and I will never not do that again. I'm never going to do it where we don't create a new LLC. Did it once, horrible experience, and, lessons learned, frankly.
Awesome. Thanks for that advice. Mark, you mentioned number one is getting educated. What would you say some of the better ways are for our listeners to get educated on investing as a LP? And just for our folks who may not understand, an LP is a limited partner, generally hands-off investors who are, while the general partner takes on the day-to-day responsibilities.
Right. No, thanks. Yeah, thanks for clarifying that. As an investor or limited partner, there's a lot of free content out there. A lot of guys we put content out. A lot of the other guys do as well. Going to events can be beneficial depending on the event. I mean, some frankly aren't very detailed. There's not. Doesn't mean the bad events. You might go there and meet people, meet syndicators. If you meet them face to face, it's great. So one, meeting people at events is great, face to face if you can do that. But if you just start Googling, as far as like learning multifamily investing, we have stuff on our website as well for that, along with a lot of other people. There's a lot of free content out there. We do a deal analysis workshop, which is 3 full days. Bring your computer. We go through deals. There's only one topic, deal analysis. And you're going to learn more in that 3 days, and you're probably going to learn in a year trying to do it on your own, just reality, because you're focused on one topic. I mean, these are real examples we go through. There's a lot of free stuff online. You don't necessarily have to pay for a lot of it. You don't, if you're just trying to learn. If you want to be a syndicator, most likely it's going to be a little more challenging for you if you're brand new. But as a limited partner, you don't have to join a group to do it, in my opinion. Doesn't mean you can't or shouldn't join a group if you want to learn through the group, but there's a lot of free stuff out there you can gather first. And you might conclude, it's not for me. I don't like it. I want to stick with the stock market. I don't want to stick with the stock market. I can't stand it. But you might conclude, hey, it's not for me. I don't like it. And that's fine. At least you know. But I would just say Google stuff, go to our website, go to other syndicators' website. There are a lot of them that actually put out free content for limited partners.
Absolutely. I think it's really, really good advice. Also, Mark, let's take some of our investors down the pathway, right? They're doing their research. They're learning more about syndication. Now they are looking to connect with sponsors. You mentioned, hey, the great way would be, meeting with folks face to face. But what are some of the questions you would say, once they connect with that sponsor, that they should be asking to learn more about their business? And are there any red flags they may want to, that are just would be obvious to a person like you and myself? Would you go down that path with us?
For sure, yeah. And we do have, just as a side note, we have like 22 questions asked, a syndicator. on our website. Now, I don't suggest you have to ask all 22, but there's certain ones on there. But what you're trying to do, there is a certain, you're in business together. There is a certain personality aspect to it. When someone makes a statement, I'm only in it for business, things like that. Well, you're in it maybe 5, 6 years with somebody. Do you want to be in it with somebody that you feel like either you're rude, arrogant, a jerk, whatever terms you want to use? I don't want to do business. I'm too old. I don't want to do business with people like that. I don't. And you don't have to either. There are enough good guys out there, right? But you want to know kind of really around is what's their background? What have they been doing? How many deals have they done? The size of the deal. Are they full-time or not in multifamily? A lot of people aren't. I mean, I started out, I wasn't either. But all things being equal, I'd rather have someone full-time for it. You want to understand, are they the asset manager on the property? Meaning, are they going to be the ones kind of overseeing the property manager on day-to-day aspect and things like that, and investors? That can be very time-consuming. And if they get distracted, if they're doing that and then trying to look for new deals, it can cause a conflict from a time perspective for sure. You want to know if they've actually had deals that have failed. And if they have, what have they learned about it? Or mistakes that they made, what would they do differently? You really want to understand the structure, how they structure deals. You might hear terms like waterfall, things like that. It doesn't really matter at the end of the day. How are you as a limited partner, investor getting paid? Is there like a preferred return where you get paid before a certain percentage before the general partners get paid? Is there, what's this, they call like a split? Is it like a 70% split, 30% to the general partner type stuff? Those are all things. And then, it can get fairly complicated. Like I mentioned the term waterfall, what happens when something happens. And one of the big things you want to understand are the fees. What type of fees do they take? I've heard people that are investors like, well, I don't think any syndication should take any fees. Well, my question to a limited partner says that, do you work for free? Do you go to work every day and work for free? No, you probably don't. Right. So you shouldn't expect, and you don't actually want a syndicator to take no fees. I mean, you might say, well, I think it's going to be better that way. Well, I can tell you that reality, they're running a business just like any other business. Now, people don't start out that way sometimes, but this is a very, capital intensive investment. As a syndicator, we've had, literally millions of dollars out at one given time for earnest money on deals. You want to understand, are they having, who does like their third party, evaluation of the property, physical due diligence, the financial due diligence, those type of things. But basically you want to really kind of get a feel for the person, what they've done before, what mistakes they have made, what type of deals they've done, and what type of deals they're planning on doing in the future. So to give you an example, we've done a lot of distressed deals, 0% occupied, 25% occupied. We've done really well on a lot of those deals. I'm done with those deals. I don't want to do any more of those deals like that. So if you said, well, I'm only if you're an investor, came to me and said, well, I'm looking for distressed deals, I can double our money in 18 months. I would say, well, those aren't the deals we do anymore. We've done those deals, so probably not a good fit. But as a limited partner, you also have to understand your risk tolerance. People, they don't really understand it until they're pushed to it and say, okay, well, that actually isn't a deal that I'm interested in. And you want to be upfront with this indicator, the lead, and tell them, this is what I'm looking for. And we do a lot of different type of deals. Not every deal fits every single person, but those are the main things, what mistakes, who they are, what they've done before, what type of deals they're doing in the future, and then kind of how they're structured from a organizational standpoint, asset management perspective I mentioned, and then also, other aspects of it as far as, are they out looking for deals still? Who does investor relations? Those type of things all important to know.
Absolutely, Mark. It's really important for them to get to know that investor, because essentially, you're right. They're going into a partnership together. You're right. Actually going into a partnership that can last 3, 5, potentially even 10 years, depending on the sponsor of the deal. And you've got to make certain that does that sponsor have maybe some of the belief systems that I have? Does that sponsor understand this business in the way that they should understand that business? You mentioned the point of ensuring that they have a certain level of experience.
Right. And the communication style is important. Like, fortunately, we have people in our group, I know them, right? Their style. So when someone else in the group or an investor says, they ask me questions, I'm very open and frank about it. I'll tell them the good, the bad about a deal. I'll tell them the good, bad about, bad, not relative about a person where they can improve and things like that. So if someone is like super high, needs hand-holding, maintenance, and high maintenance, if you want to call it, as an investor, if they exist, And I know the lead or the asset manager is more of the type that they're not, probably don't have the aptitude for that. Then you want to make sure they're not connected up together. It's just going to be, it's not going to be good because, to your point, it is the personality and you're in it for 5 or 6 years, whatever it's going to be. And you don't want to just get frustrated, right? In that situation where, and I have an old partner from before that his communication style is 100% different than mine. I'm very, very responsive against anybody in the industry, but his style more is like, well, if I don't have the answer, I just won't respond. So, 3, 4, 5 days go by and still no response. Well, a lot of investors don't like that. They start freaking out, right? What's going on? What to get myself into? So if nothing else, respond back saying, I don't have an answer, but I'll get back to you. And that can help eliminate some of that. But if you're, like I said, if your sponsor is not the same style of you for communication to, pretty closely, then I would look for a different sponsor that meets your communication style.
Makes total sense. Mark, how would you advise an investor who's looking to now, done their due diligence, met the sponsor, they're now wanting to decide, hey, what kind of project should I be in? How would you advise them from a risk reward perspective? What type of projects that they should be choosing?
Yeah, personally, as like you said, risk reward. As someone coming new into this and they want to, potentially invest in multiple deals and make this, part of their portfolio, I would look for deals that are more, let's call them a double than a home run. Mm-hmm. So I personally, no matter what, if I was a new investor, I would, in a limited partner standpoint, I would look for deals that occupancy is already pretty good. 80s.
And what's pretty good?
They say maybe mid to upper 80s to mid 90s. I wouldn't look for deals that are 50, 60, 40% occupied. Those deals, a lot of reasons those can be tough deals. You want to understand as far as what's the projection for distribution. So if someone says I'm retiring, I want to have cash flow on a monthly basis. Well, you know what? Those deals that are big distressed deals aren't going to have cash flow for 2 years probably. So you don't want a deal like that. So understanding the profile for that, the deal profile, and then what are kind of the similarities? So if someone came to me and said, hey, Mark, you have half a dozen deals all out there to be funded, which, isn't unusual. What do you think? What do you like about the deal? What you don't like about a deal? It's like, well, if I'm going to exact same market I've already been in, and I'm using the same general partnership team and the same property manager team, the same attorney and same everything, right? The risk is lower. Mm-hmm. I'm not saying there's no risk, and I'm not saying that deal couldn't be where it doesn't perform like we think it should, but the risk is lower the more similarities you have. If you go to a brand new market, which we've done, we're in 14 states, but we just closed on a deal in a brand new state, and it's always, all things being equal, that's a riskier investment because there are more unknowns there. It's a new PM company, it's a new state, all those things like that. Understanding, are they going to pay? They pay quarterly, they pay monthly. Those type of things would be important to know. We're trying to understand, that there is risk involved. And when people say, well, what's my guarantee? They're not a good investor, at least based on that statement by itself. There is no guarantee, just like there's no guarantee in the stock market, or even I would even argue in the bank, there's no guarantee. But the reality is people say, what's the worst thing that could possibly happen? Well, the worst thing that could possibly happen is you lose all your money. Now, do I think that's going to happen? Has it ever happened? No, but it could happen. So you need to go into it, understand there's risk involved. If you look at the investment standpoint compared to other investments, I will agree the risk is substantially lower than, most virtually any other investment. It really is. But trying to understand the whole risk profile to the person putting the deal together or the people putting it together, the experience, and then the deal itself. What, will the deal work if they don't do their business plan? So an example, we bought a couple deals right before COVID. The business plan was to re-tenant properties, put in whatever it was, $20,000 a unit CapEx. 2 months later, COVID hit. What did that prevent us from doing? CapEx and evicting people. So we sold the properties and ended up doing okay. But the reality is that the business plan only worked if we did that. I would much rather invest in a deal that says, well, you know what, we're going to try to increase rents, put CapEx improvements to the property. But if there's some reason why we can't do that, then the business still works. Like there's still, good return and things like that. The other important thing to understand is where you're investing, in the country. We saw when people say, well, this state is landlord friendly. That's a pretty bold statement. In a lot of cases, it's true in some states. Other states, people say, oh, Texas is really, landlord friendly. It wasn't in Dallas County. Why? Because the judges weren't landlord friendly. They're not. So other counties in Texas, they were. So we learned a lot during COVID as far as who really was landlord friendly, and it's county by county. It's typically not state by state, although there are some exceptions where some states you could say are landlord friendly across the board.
Got it. Okay. So now that they understand their risk reward profile, they've chosen the sponsor. What's the typical frequency you'd say that they'll be receiving payouts based on what you've seen in the market?
So typically, depending on the type of deal, but we'll usually say, 6 to 9 months before you get your first distribution. Could be sooner, but we typically will accrue it, meaning it's still owed, and then quarterly thereafter. So there are some people, few here and there, that do monthly. It's not very common, but typically quarterly is what we'll see for distributions.
Awesome. And there's been a lot of noise, Mark, in the market, considering, we're in a recession, pending recession, et cetera. What would you say is your outlook right now with investing in multifamily real estate?
Well, a lot of people say, hey, you start looking for deals. So let's ignore deals that are already in existence, right? And look at new deals. If you look at what's going on in the market right now, and we're seeing discounts, 15% or so, what we would have seen 9 months ago off a deal. So we bought a deal, we closed on, I guess it was December. It was, I think they want 127 a door. We got it for 106. Okay. Well, but it's the top of the market. I mean, the rates are really high and, all the stuff like this. Well, reality is if you underwrite the deal with the rates as of today, right, and things like that at a lower price, I'm okay with it. Now, what happened, unfortunately, it even happened to us and virtually anybody else that was buying, was during contract, last year, rates went up in some cases, 300 basis, like 3%. And, because some of these deals took 6 months to close for various reasons, things like that, which is a little bit longer. So if you underwrite a deal with the rate and assume the rate's going to be that rate through the duration of the hold, even though, all things being equal, you should be able to get lower in some cases if you go to permanent debt, as an example, and you're getting a lower price on it, then I have no problem buying. What we've seen pretty much across the board is that the total returns and internal rate returns still look good, but the cash and cash, there's no arguing that cash and cash is lower. I mean, rates can't double, and your cash and cash will take a hit. So that's where we're seeing some issues but going forward, it is a little more predictable now than it was before. It is. And if you get discounts, you should be good.
Awesome. Right. So there's definitely opportunity in the market.
There are, for sure. Anyone trying to sell today, as a general statement, probably has to sell. Either there's a partnership issue, medical issue, divorce, their loans coming due, they can't make their mortgage payments. I'm getting called on a regular basis from people that have problems.
Yeah, because there's folks out there, like I was mentioning at Noise, that are trying to compare this to, let's say, the 2008 crash. As you could probably speak to, there's definitely a lot of fundamental differences between 2008 versus what's happening now.
I mean, the biggest major difference that no one can argue is lending is 100% different than it was before. And lenders are so strict right now. Leverage is so low right now, and they're making put reserves in. I mean, they're trying to, protect their risk. They're smart guys. They are. Versus, in the last one in 08, it was the opposite. You're getting 120, 130% of the value. You're getting, 80, based on value, you're probably getting 85% on a loan. It's completely different from a lending standpoint right now, what lenders are doing. And that, while I don't like it in some cases, it does give you a little more comfort level that, hey, it's not, in my opinion, it's nothing like 2008.
Absolutely. We're looking at lending at 55% LTV right now.
No, I mean, in a lot of cases, you're exactly right. We had one that got quoted 54%.
Right.
Yeah. Now, there are some that are higher. We've gotten higher, but, that's reality. Where in 2008, we probably would have because they would have valued it higher, probably would have gotten 80%.
Right.
Yeah.
So there's definitely a big difference right now happening in the market. And I think investors should really pay attention to the fundamentals of the market now versus what it was in the past in order to make an informed decision on
Right.
investing.
It doesn't mean we're not impacted, obviously, right? Because we are. But I think it's a different scenario than it was then. And I'm not one people project things. I could be on your podcast and you could have me on tomorrow. I'll say two different things and say, look, I was right. Can't stand when people do that, right? It's like, everyone makes people say, just multifamily is overinflated in 2013, 14, 15, 16, 17, 18, 19, 20, 21. Now, 2022, it's actually, well, you missed out on 7, 8. I mean, what? I mean, now you're saying you're right because it's overinflated now. I mean, it's just ridiculous. These guys that project things like that and say things and then act like they're, geniuses. We sold 21 deals in 2021, top of the market. I mean, made a lot. Is it because I'm a genius? No, it's not. Was it because I partly got lucky? Yeah, it was. I mean, I knew that we had the value there. I want to take stuff off the table, but it wasn't like I could sit back. Look how smart I was. I sold all these deals at the top of the market, because I knew what was going to happen. No, I didn't know what was going to happen, and frankly, no one else did. They can say they knew, but they don't. But reality is, nobody knows what's going to happen between now and a year from now, or 6 months from now, or even a month from now. But it's like you mentioned, do your homework, be smart investors, be well capitalized. When people say cash is trash, that's a silly statement as well. I can tell you, I've been in much better positions where even COVID deals that had cash in the bank, like a decent amount, I felt way better about than the deals to where like, oh, you know what, we don't have much reserves there. I'm not saying get crazy with that, but these statements, and stop listening to these people that say these silly statements because they're completely untrue. And people get sucked into it, and then they spend all their cash. I can tell you having, I deploy a lot of cash, but having some cash set aside has allowed me to get some tremendous investment opportunities, like ridiculously tremendous investment opportunities. So I wouldn't get that. People say, well, you just get a line of credit and things like that. Well, the reality is a lot of people can't do that. So there's nothing wrong with holding some cash. I don't want a lot of cash held back. But, like I said, people make statements that, are incorrect in my mind.
Yeah, absolutely. Now, Mark, we're running low on time, but I definitely wanted to get to know you a little bit more, right? If there was a magic wand that you could wave to improve your business, what would it be?
For us, it's actually the current deals that we have where, some of the deals we didn't have what's called the rate caps, like an insurance policy, if you want to call it that, interest rate protection. We have a handful of deals that don't have that. I would love to wave a wand and go back in time and say, hey, get rate caps for those that were 30,000 that went up 900% to buy them, after 6 months. So it's mostly those deals, and the deals we've struggled with, but also made the most on are those distressed deals. So I kind of want any of the distressed deals out of our portfolio, frankly, and start buying, better assets, maybe a little lower return, which it will be, but lower risk and less headaches and more predictability.
What advice would you give yourself as an investor, as an LP investor, when you just started in the business?
I would make sure, because I invested in one investment where someone was new in a hotel business. I think I would say make sure that someone's done a number of transactions. I might talk one or two, let's say 10 plus, whatever the number is, and make sure that lead is well capitalized. And, you're not talking $10,000, $20,000 typically, but, it's usually going to be, whatever, pick a number, $250,000, 500,000, whatever, that they're laying in the bank for, they need to cover the mortgage for the month or whatever like that they can do that. And that they have the willingness to do that. Some won't do it, but I would say making sure being less reliant on like, hey, just a relationship with somebody, which is nice and good and liking somebody, but also making sure that they have the track record and the mistakes and the capital to make sure a deal. Because some of these deals, to be frank, they're this next 6 months, whatever, they're surviving. They're not thriving. Some deals are, but a lot aren't. A lot are just surviving. People are like, well, what's going on? It's like, you think you don't know what's going on in the market, but I see it on a regular basis. We have 65 deals or whatever, and I'm getting called pretty much on a daily basis about people outside in the industry that are having problems. They're going foreclosure, they're doing whatever it might be. So just being careful on those aspects of it. And like I said, the capital piece of it, because if they don't have it, they're coming to you, the investor. You're not required to put money in as an investor, but they can dilute you. And in some cases, they'll charge your interest on it as well. I've seen that before. So, and making sure that you understand what's called the private placement memorandum, PPM document, making sure you really understand what's in there, because I think a lot of investors don't even read it.
Got it.
And there could be one sentence in there that completely changes the deal.
That's really, really, really good advice and super detailed. We really appreciate that. And if there's one book that you'd recommend that has impacted you, what would that book be and why?
I really like the book Keith Cunningham, The Load Less Stupid is what it's called. And he talks about like the dumb tax and things like that. And I like the book because he's very blunt to the point, which I really appreciate, frankly. But it talks about a lot of things, mistakes that people have made, how to avoid them, and how to really structure your business. You don't have to be a syndicator to do this, but it's really how to structure things, even from an investment standpoint, questions to ask yourself. And you don't know the answer, ask other people. But I really like that book.
All right, awesome. And is there anything, Mark, that you're working on that folks should know about?
We have deals on a pretty regular basis. We did 30 deals last year as a group, so we're pretty active. And then we have some events that we do a few times a year. Deal analysis. We do one that kind of goes through and another one goes through all aspects of multifamily and things like that too. So those are things we're working on. And then other things I'm working on, a little irrelevant to the new investor, but it's some of the deals we have already in our portfolio. They're working on those, either refinancing or selling, things like that.
Awesome. And Mark, you dropped a lot of knowledge bombs today. We really appreciate that. And I'm sure our folks are going to want to, get in contact with you. What are some of the best ways to connect with you?
They can reach out to me via email. My best, it's Mark, MARK at thinkmultifamily.com.
All right. Fantastic. Mark, thanks for coming on the show today. We really appreciate your time and going into such great detail to help our folks become better investors. Thanks so much, Mark.
Thank you. I appreciate it.
We trust that you enjoyed today's show. Visit archcapital.ventures to learn more about how you can leverage real estate investing to improve your life through passive income, financial freedom, and generational wealth.